What's it like to lose 50 million?
Oh, it's great, man. It's just the greatest thing that's ever happened. It sucked. Okay. It was like the worst. I thought I was set for life, guys. I mean, really, I had 800 houses. I had multiple apartment complexes. I've owned a couple thousand houses that I've rented long term. I own thousands of apartment units now. In 2006, my net worth went up $17 million while I slept, and you might say, wow. And of course I said, wow. And I got a head so big I could barely fit it through a door. And that's when God decided to give me a nice little smack. And that was 2008 and 9 when I lost 50 million bucks.
What are some of the first lessons that hit you when the market turned?
Yeah, well, I'm going to tell you what I tell my students now is conserve cash. So if, for example, if it gets bad, you might slow down your CapEx on a project, conserve that cash. But I got to tell you, I saw pitch decks from some of these operators, Kenny, and there's no operating reserve. They don't put any money in the bank, in case the what hits the what. No money at all. We do 6 months minimum on an asset of expenses as operating reserve. So, that's one. I saw exit cap rates at 10 basis points a year, even in the most recent past. I'm like, are you serious? If you look at a graph of interest rates in 2008 and 9 and you put cap rates next to it, it almost mirrored interest rates. Cap rates are going to go up. It's a given. And so, the aggressive nature there. But I think the big thing, Kenny, is what you just said. These operators have not been through a downturn. And so tight asset management is going to be critical.
Lenders are doing lower loan to values. They're doing higher reserves. We did a cash out refi on a property I've owned for 15 years, and the lender made me put $1.5 million as an operating reserve against the potential renovation costs.
Wow.
So the lenders are starting to do cash reserves. It should be a red flag for people, but to your point, some of these guys are running pretty thin.
Well, and let's talk about bridge debt for a minute, okay? I mean, there's, Fannie and Freddie dropped their loan to value. We've got a deal right now in Nashville, 60% loan to value, 10-year fixed rate. I mean, we still got double-digit cash on cash and great IRR and AER, and we're raising $19 million for a $33 million deal, okay? And still have good returns. I mean, it was a good one. But the point is these guys were getting bridge debt because they couldn't get conforming decent loan to value on conforming debt. And so they're getting bridge debt at loan to cost in some cases, 75, 80% loan to cost. And, that's adjustable rate short-term debt. I mean, I think there's going to be some real pain in that environment. I really do. Even if they got a rate cap, let's say they bought a 2% rate cap. I mean, you and I know a 2% increase in your debt is a big freaking deal. And some of them didn't get rate caps. So, I think that's going to be an area that sees a lot of pain.
But the problem is that the rates have went up. So people thought they were going to be able to get that long-term debt at a lower rate. Right. And now they have to have more cash flow to get it at the higher rate.
So there's that. Yeah, exactly right. That's going to be a big problem because, they have to refinance out of it. And if the cap rates have gone up, that's going to affect the value. If they haven't, now luckily rents have gone up, which may save a lot of people, and they probably will continue to go up because there still is a shortage of rentals. But, that's got to stabilize at some point too, where the people can't afford to pay anymore. I mean, look at inflation and gas and everything else. It's insane right now.
Ross, my partner, and I, we looked at one building that we own right now. And he told me last week, he's like, I went back and looked. If we wouldn't have bought a rate cap, our monthly payment would have gone up by $70,000 a month on one building.
That's exactly what I'm talking about. And
if
some
we
of these,
wouldn't have.
And they didn't insist on rate caps a year ago. Now, these last 8 months, you pretty much couldn't get bridge debt without a rate cap. But I'll tell you, we quoted a rate cap on a bridge loan on a $44 million purchase, and the rate cap was $1 million. The American families have now lost, according to this guy, $460 a month. Okay? I mean, for an A and B demographic resident, maybe that's not as big a deal, but man, C assets, that's killing people. And like I was saying before we started recording, there was an article in Fox News about 3 weeks ago, 20 million families are behind in their utility bills. 20 million families, not just people, families. I'm like, holy cow. And I was telling you, when I crashed and burned, I lost everything in 2008, 9, I started a litigation support company. Okay, that was kind of out of the ashes. I built this litigation support company to help people that were in foreclosure. And we helped thousands of families save their houses. I formed law firms in 5 states, and we fought the foreclosures, and we did loan modifications, just helped a lot of people. I hated the business because nobody's happy when they're losing their house. But, it turned into a $10 million company with 60 employees that I sold a few years ago. But I had lunch with the guy that I sold it to just a couple days ago. Yeah, I'm sorry, last week. It was like Thursday or Friday of last week. And he told me that the pent up foreclosures are like a rat going through a snake. I mean, they've stopped all the foreclosures, and all of those are just sitting there, that are getting started and ready to go. So, I'm not trying to scare you guys that are listening here, but I think it is going to turn ugly, and it's going to look ugly, but with crisis comes opportunity. So don't get scared, get excited, conserve your cash, learn, pick a vehicle right now. If you're going to do multifamily, learn from Kenny, come to one of my boot camps. I've got a virtual one coming up here in a couple of weeks, but learn the business right now. Don't wait. Because if you're trying to learn it in the thick of it, it's going to be too late. You need to build your relationships now, get up to speed now, learn it as quick as possible. If you're going to do single family, go learn that. You're going to buy businesses, go learn that. You're going to trade stocks, go learn that. But get up to speed right now, because opportunity is knocking.
What do you see in the next 2 years? Because I've kind of projected out that where I think the Fed funds rate's going to be, where I think they're going to hit the 2% target on inflation. I think it's going to really create massive wrecks and a lot of these asset bubbles we've created. What do you see?
Well, I mean, the debt is insane right now. I mean, I think there has to be a reset. I really do. I think, it's global too. You look at China, and I'm sure you follow what's happened with the real estate development there, and it's almost like a Ponzi scheme what they were doing there. They're obviously going to continue to raise the rates. That's the only mechanism they have besides quantitative tightening, which I think they've already started as well. They're which is pulling money out of the market.
People oftentimes put real estate into one box, but what happened was a lot of people fell out of residential into rental, and they're very different. And I know a lot of people are buying residential as rentals, but I'm talking about multifamily. And what happens is right now the affordability has pushed people into rentals. Number one, whether they're residential rentals or multifamily rentals, it doesn't really matter.
Right. They can't buy a house right now. Right.
Yeah. So I think, and then you top onto this debt issue. I think that I see a massive pushback into the rental housing into the market. How about yourself?
Oh, I agree with that. No, I mean that metric is there. There's a shortage of housing units. People can't afford to buy. There's a gap there. So our business is solid. There's no question there. But and I don't think I think there are a lot of operators in the multifamily business that will do just fine. But I think the ones that did these skinny deals, that got this adjustable rate debt, that don't know how to operate in a downturn and aren't paying attention to their KPIs and their